We've got Chapter 8, and Chapter 8 is going to deal with, as you can see, receivables. If you haven't noticed, we're going down the balance sheet. So we looked at cash, inventories, and now we're going to look, or inventories rather. Now we're going to look at receivables. What we're going to look at first, and this first learning objective is going to examine the different types of receivables. And what you might find interesting is how to record regular credit sales and debit card sales when they relate to third-party vendors. All right, so we know that companies will obviously sell in the ordinary course of business. They will sell on credit. One of the things you have to keep in mind is that when you look at a business that does not sell on credit, they're giving up the opportunity to make lots of sales. So when you think about offering credit to customers, you have to think about the relationship between credit sales and increasing sales in general. So if you don't offer credit, the probability is your sales would be lower. So offering credit raises your sales. So most companies will offer credit, customers will buy on account. Now, by definition, you should know what a receivable is, and don't need to read this. It's simply a claim that you have against a customer. Customer buys the goods, they don't pay for it now, they promise to pay for it later. And this is known as buying it on account. The problem is that when you sell on account, there is a very good probability that you're not going to collect all of those receivables. So let's think about what I just said, and I'll say it again just to be sure. If you want your sales to increase, you have to offer credit, correct? But by selling on credit, there's a chance you may not get paid by everyone. So the cost of selling on credit is known as a bad debt or an uncollectible account. And that's what we're going to be looking at today. So we have to think about the probability of individuals not paying on time. So the accounting issues that are related to receivables are, we know that you're not going to pay the full amount. What we need to be sure that we do is properly value the receivables and properly determine the amount of the cost of selling on credit. So the two things, again, that you have to think about when you deal with receivables. And once again, it's always going to be a balance sheet and an income statement perspective right now. We don't get to the cash flow statement again until the very end of the semester. So what we need to worry about is going to be accounts receivable, and the issue here is valuation. And then on the bad debt expense, we know we're going to have to come up with an estimated measure. We'll get back to that. So those are our two issues. And again, remember that receivables are on the balance sheet. And the bad debt expense is going to be on the income statement. So the question is, what's the proper valuation of the receivable, and what is the expense that we incur? And this is the cost of selling on credit. It's the cost of selling on credit. And these are the two primary concerns we have. How do you properly value the receivable, and how do you measure that bad debt expense? How do you measure the bad debt expense? Now, when you look at this, it is exactly the same issue you had with lower of cost of market. Because when you looked at the lower of cost of market and inventory, what were the two problems we had there? Is the inventory properly valued? Is it overstated? How much do you think you're going to get for the inventory? It's the same question here with the receivables. How much do you think you're going to collect? and you have to value it at a lower amount because you can't expect to collect all your receivables. The loss that we took when we had lower of cost of market, we debited cost of goods sold, which lowered our income, and now we're going to debit a bad debt expense. So it's the same issue. And you're going to find that whether you do this accounting as a profession, whether you deal with this as a manager or a financial analyst, you're going to find that there are a handful of fundamental issues that keep repeating themselves. So this is exactly the same as our concern when we looked at the lower of cost of market for inventory. Okay. Now, let's take a look, before we get into this, let's quickly examine the types of receivables that we have, just by way of review. And all of these receivables are subject to the same issues. You have your basic 3 types of receivables. You've got accounts receivable, notes, and other. Accounts receivable and notes receivable could be used in the normal course of business. They could be used in your normal trade. Other receivables could be tax receivable, if you have a refund coming. It could be receivables from loans to officers or loans to employees inside your business. You could also make other types of, extend some credit to other customers. So in accounts receivable, that's normal trade. Your notes could also be trade, but they could also be lending to others. Other receivables could include tax receivables from tax refunds. Okay, now as we said, accounts receivable are typically, you should know this already, typically your trade receivables, normally they are 30 days in duration, and these are incurred typically, or I should say they're recorded as part of the normal course of business. So to summarize, when we look at accounts receivable, these are the 3 things you should know. There are trade receivables. They will be generated from the normal course of business, part of your normal operations, and the collection period, I would say, is typically 30 days on a receivable, on an accounts receivable. On a note receivable, this is if you lend money to customers. That's one way to come up with a note. You could also have notes receivable in some cases where, let's say you have a customer with an account receivable and it's due in 30 days, and they say, well, I really can't pay you now. Could you extend the period that I would have to pay? You may actually give them a note to sign as a promise to pay. That's a big difference between an account. An account is simply using a credit card, for example, or calling someone up that you know as a normal business relationship and say, send inventory over or send merchandise over, and you promise to pay. A note is a more formal document that has to be signed and generally carries with it interest. So as you can see, the note in the second bullet here is a legally binding document, and it is a promissory note. Yes? What happened? Is a question? Oh, I'm sorry, Sebastian. Yes? I'm sorry? Okay, if you don't pay the note, well, you can be prosecuted on a receivable also. What could happen? It depends on the prosecution, but you do get, there is legal proceeding. If you have, you could file for bankruptcy. Bankruptcy court is, actually the question he asked is, could you go to jail for not paying bills? And the reason why we have bankruptcy law is to prevent that from happening. Because I don't know, did you ever hear of debtor's prison? Years ago, people used to be incarcerated for not paying their bills. Now, unless it's fraud, there's a chance that you can continue to have a chance to pay, or they give you the opportunity to pay. You could file bankruptcy, and they spread out the payments. But what it does, if you don't pay it, it erodes your credit rating, and it may be very difficult for you to get a mortgage or an auto loan or college loans or anything else down the road. Okay? All right. All right, any other questions? Okay. And of course, don't forget, notes could also be used to finance large purchases. So for example, auto dealers, those are notes that they have, notes receivable. When you buy a car and you sign a note, if you have an auto loan, you could also have cases where companies sell very large and very high dollar products, and they would use notes for that purpose as well. And again, the note is a promissory note. It is generally going to carry with it interest. And we'll talk about that interest as principal times rate times time. It's a pretty simple calculation. And the notes are generally long-term, typically much longer than accounts receivable. But you could have some long-term notes. An auto loan could be 3 years or 5 years, or they could be shorter term, which would be 180 or 90 days. So to summarize, again, what you should know about a note is that it is a formal document. It's a promissory note. It's a formal written promise to pay a fixed sum of money, typically with interest. It is going to have a longer collection period than accounts receivable. And I would say probably it's going to be at least a 90-day note, maybe a year, maybe a 2-year loan. Auto loans are 3 years. College loans, you might have 5 years to pay back. I don't know the exact term on that as well. Okay. And finally, before we start looking at transactions, you have other receivables. Not much to say there. Other receivables could be tax refund receivables. You could have dividends receivable if you have investments. Interest receivable on loans that people owe you money, and you have interest that is due to you but unpaid at the end of the period. You could also have loans to employees or loans to officers of companies. All right, now, with that background, we're going to take a look at credit sales first, then we'll look at notes. When we look at credit sales, you're going to have to distinguish between two types of credit sales. Credit sales offered by the company and credit that is generated by third-party vendors. So there's a big difference, and you may not see it. For instance, if you've got a Sears credit card or if you have a Visa card, when you go into the store, you think of it as the same thing. But it's quite different from the store's standpoint. If Sears is offering credit, then we account for it the same way that we've been accounting for it throughout. Your debit accounts receivable and credit sales. But if you have a debit card or a MasterCard or a Visa card or Capital One card, whatever you carry with you, the accounting is much different. In fact, the accounting is exactly like a cash sale. So let's see that. If you have a regular sale on account, now this is credit offered directly by the seller, so let me make sure that's clear. This example is going to be for a company that is offering credit directly to you. It's not a third-party vendor. You're not coming in with somebody else's debit card, or you're not coming in with somebody else's credit card. And also what we're going to find out here is that we now have to be very careful because we have more than one customer. We have multiple customers, so we have to identify the receivables obviously by account number. We wouldn't do it by name, but by account number. You know yourself, if you order something online, there's a customer number. So we're going to give you a customer number. Here we're going to talk about names to associate a specific account with that individual. So they have service on account of $5,000 for Brown and $10,000 for Smith. So that we're going to ignore cost of goods sold, and the $5,000 sale on August 8th to Brown debits accounts receivable and credit service revenue. Now you notice that the customer's name has to be listed next to the receivable. In the internal system of the information system of the company, that would be a customer number. So not only do we need to track accounts receivable in total, we have to track each individual customer's balance. So we debit accounts receivable for this particular customer, and we credit the sales revenue. Now, that's going to lead us to something that you haven't seen yet, and that's something known as a subsidiary ledger. What we know right now is the general ledger. We'll talk about the subsidiary ledger in a moment. And of course, the sale to Smith is the same thing. We debit accounts receivable and we credit sales, but the debit to accounts receivable now is going to be going to Smith's separate account. Now, when we look at the accounts, right now on the balance sheet, you got accounts receivable of $15,000, but we need to be able to identify the customers that owe us that $15,000. So what we need to be able to do is to find a system, an information system that allows us not only to report the full $15,000 on the balance sheet, but we also need to find out who owes us the money so that we can collect it, and if they don't pay on time, if we need to turn those accounts over to a collection agent or, as we said before, over to an attorney. So again, we need to have the total of $15,000 on our balance sheet, but at the same time, we must have the ability to identify the individual customer's account. Those individual accounts will be in what is known as an accounts receivable subsidiary ledger. And obviously it's impractical to have thousands of receivables on our balance sheet, so we condense those subsidiary accounts into the general ledger account. So now we have two different ledgers. We've got a subsidiary ledger and we have the general ledger. When you look at the general ledger now, accounts receivable in the general ledger is known as the control account. So the general ledger account is known as the control account, and the individual accounts are in the subsidiary ledger. So this relationship is shown here, where on the balance sheet, you're going to see $15,000 of accounts receivable, and that's all you're going to see. Inside the company's information system, there are layers of other types of ledgers, and this is not the only ledger. This is going to be a receivables ledger, so we know who to collect from. What else do you think you have? Accounts payable subsidiary ledgers. Why? You need to know who you have to pay. There's also going to be lots of other ledgers like cash. You'll have separate cash ledgers that will tell you where your money is, what bank accounts. Just like you know yourself, if you have more than one, you have a checking and a savings account, you got to keep those separate. You know, you add them up and say, I got a total of $5,000, I got 3 in checking, 2 in savings, but the total is what gets reported on the balance sheet. So from now on, anything on or any receivables that are on the balance sheet would be totaled in that account that we call accounts receivable, but it's now considered the control account, and all of the individual customer accounts are accumulated in a subsidiary ledger. Now, of course, you have to realize that there's not just 2 accounts. You'd have hundreds, thousands of different accounts. And for us, we're looking at names. Not only would you have names, but you would have numbers that would be able to be traced, numbers that the information system would be able to call up. So sometimes they ask you for your name or they ask you for your account number. Did you ever call looking for something, you have a problem with an order, and they'll say to you, what's your name, or could you give me the order number, or could you give me your customer number or your account number? So if I had your customer number, I could pull up the same information as if I had your name. And that's the way the information system works. Yep.
So is it in order by the account number or by the date that
You're going to have within account number, you're going to have dates and transactions. So transactions would be chronological within the account. How the accounts are listed is going to depend on the company. I would imagine they would probably be in an alpha order, or they could be in customer number order. It depends on the company. So your accounts could be listed in, as you can see here, they're alphabetical, or they also could be numerical, in numerical order. Okay. All right. Now, these are the accounts that we worry about internally, because this is the credit that is offered directly by the company. Mostly, you see, and you do have company accounts, and large companies would have, especially if you're a wholesale company and you're selling to retail companies, they would have credit, trade credit. But in a retail setting, if you go into a retail store, most transactions are either cash, but for the most part, they're going to be third-party vendor credit cards and third-party vendor debit cards. And here's something you might find surprising if you haven't read the chapter yet, and that is that third-party vendor cards are treated like cash sales. So if you come in with a credit card, it's as good as cash, except there's one downside, there's a fee. So when you come in and you debit for a transaction, or you credit for a transaction, that is recorded on my books as a cash sale. However, we have to be cognizant that there is, in fact, a fee that's going to be charged. The fee could be from 1 to 5%, depends on the company, on credit cards. And that's why, let me bring that screen up, it's 1 to 5%. And that's why, in fact, you might ask, and I think you might have figured that, I don't know if I don't live in New Jersey, but I guess if you you don't pump your own gas here unless you do it illegally, but when you're pumping your own gas and you're staring and you're deciding which one to buy, some gas stations will say cash price and credit price. And I guess the credit price is higher. Well, that's why, because there's a fee. So there's a fee that's charged for the credit price. So the credit price is going to be higher to cover that fee. Now, the question becomes, it's a cash sale, the question becomes, when do you recognize the fee? Do you recognize the fee at the point of sale, or actually it's only a couple of days later, or maybe at the end of the week, because they cash these things in pretty quickly. So do you wait until a week or 2 weeks later to assess the fee, or do you recognize the fee immediately? If you recognize the fee immediately, it's called the net method. If you wait and record it only later on, it's called the gross method. The net method records the sale and the cash net of the fee, and the gross method records the full sale in cash, but records the expense later. So let me show you that. So if you, again, we treat them the same as cash sales, and there's your summary. Cash sales or credit card or third-party vendor sales are treated the same as cash sales. And here are the two methods. Let's see the net method first. The net method records the credit card fee as an expense immediately, as soon as the sale is made. So let's say that our friend Smart Touch Learning sells inventory to a customer for $3,000, and there is a fee of 4%, so that's $120. So they know that when they sell this for $3,000, that you're going to have a 4% fee. Yep.
Is that why some companies have minimum credit card?
Yep. Yeah, so it's for the minimum. Now, the other thing I was just thinking, it's kind of like, I think what the gas stations do is pretty fair. It's reasonable. But if you went into, let's say you go into an Apple store and you buy a MacBook Pro or something, you got cash, it's the same price as if you have credit. So essentially, they keep the price at a certain level. So if you pay cash, you're kind of like at a disadvantage because you're paying that premium anyway and not having the opportunity to use credit. Not that it matters that much if you pay your bills right away, but they sometimes build it in to the same price. And I don't know what we do here for tuition, if you can use a credit card, whether or not there's any additional fee, but some schools charge an additional fee if you use a credit card to pay your tuition. And that also is part of this as well. Okay? So the fee here is $120. The fee is $120. The question is when you recognize it. When you use the net method, notice what happens. Under the net method, we will deduct the fee immediately and record the cash as $3,000 minus the $120. So if you look up at the screen, you'll see that the sale is $3,000. The 4% is the fee, or $120, and I'm going to collect $28.80 maybe in a couple of days, but I recorded this cash right now. I know I'm going to get it. So I record it immediately, and I deduct the fee, and it's only a day or two, as I said, wait, typically, and you debit the credit card expense and credit sales for the full amount. That is what we mean by the net method. You deduct the fee immediately on the date of the sale, which was August 15th. Now, I have another option, and I'll take questions, I'll go back to this, but the other option is the gross method. In this case, I have to make two journal entries because what I need to do is record the sale at the full $3,000 amount, and then when I collect my cash and it's less than the $3,000, I'll have to record the fee. So I wait to record the fee until I settle up with the debit or the credit card company. So in this case, once again, it's a $3,000 sale at 4%, the $120 fee. And on the date of the sale, which is August 15th, I don't record the fee at this point. I essentially treat it as a regular cash sale, and I'm going to debit cash and credit sales. And that's going to be for $3,000. Then when I ultimately collect, and let's say it's at the end of the month, this may be longer than typical, but at the end of the month, when the credit card or the third-party credit card or debit card company actually assesses that fee, I'm now going to have a debit to credit card expense, and a credit to cash. So it's the same result. You still get the net of $28.80 as cash. It's the same result, except that it is recorded at two different points in time. Okay. All right. So any questions on the net and the gross method? Yeah, Anthony. It just depends. Yeah, it depends on the company's preference or priority as to when they want to recognize that expense. It all depends on their accounting information systems as well. What they you have to think about this. Years ago, we used to call this the dumb bookkeeper argument. Now we're calling it the dumb computer argument. Computers can't think, kind of, right? So they really can't. They may not be, depending on your system, they may not be able to differentiate between a cash sale and a credit sale. So if I want this as a cash sale, it depends on my information system. If you came in and gave me $3,000 in cash, or if you came in and used a debit card or a credit card, I want it to be recorded the same way. So I don't want to have to code or do something special. And it depends on your business. If your business isn't sophisticated enough, you can't differentiate between a cash sale and a plastic sale. So this would be the way to go. And then later, when the fee is assessed, then you record the expense. It's a good question. So, why have both methods? And of course, the net method I would use if I'm able to code my sales properly, if my cash register is geared up properly for the information system that I need, then it's easy enough. Then I can differentiate between sales, credit, and debit, right? And you see that now. If you, swipe your own card for gas, which you could do in New York, basically says debit, credit, cash, right? So it gives you the options, and probably that's what's going on in terms of the accounting system. Okay. All right. Any other questions? Okay. All right. So just a couple for you now. The first one, I'm going to do this one, of course. This answer is true. This is just a definition. This is just a definition. All right, so don't forget we're on 74 now. If you look up here, so the answer is true there. Okay, let's do the next one. In the next question, it says businesses must maintain a single account receivable for all customers. They must maintain a single accounts receivable account for all customers. So let's say channel 74. Yeah, one account. One account. Yes. What's that? What's that?
Does it matter which ledger you're talking about?
Yeah, it does. It does. It's kind of tricky. Okay. All right. So this one, no, because there's if you remember, you have separate accounts for each customer. So those are the subsidiary accounts, and the ledger account is the control account. So you have one single account, which is the control account. You get separate accounts for individual customers. So that one's going to be false, right? So that one's going to be false. All right. That one's going to be false. All right, let's do another one. Okay. Now, this one, let me ask you this one. Sales made through third party, question? Yes. Okay.
They do need one for every customer.
Yeah, okay. All right, I'll go back to that one. I'll correct that one. All right, so let me do this. We'll make it, so for wording, let's do this one. Sales made through third-party vendor credit and debit cards are journalized in the same way as cash sales using trade accounts receivable. Okay, so credit card sales using trade accounts receivable. And the answer to that one is going to be false, because trade accounts receivable, how do we record those? Debit accounts receivable, credit sales. And for plastic sales, we're going to treat them as cash sales. Okay, so this one is going to be false because we record third-party vendor sales as cash. Okay. Internal credit, the credit that we grant, is treated as a regular debit to accounts receivable and credit to sales. All right, now, got this last one. I'm not going to do that. By the way, this one, what is it? This one's just definitional. C is the answer to this one. Notes receivable are just longer term. Okay. All right, so here's the one. Let's see if you can figure this one out. Made to order. A custom garment seller accepts payment through credit cards. It's not a it's a third-party vendor, and credit sales are 12. Processing fee is 3%, and we want to know if the entry that you see there is correct for the gross method.
Can you just go over this one real quick?
We want to know if it's the same as accounting for trade receivables. Trade receivables are accounted for as a debit to accounts receivable and a credit to sales.
Debit to accounts receivable, credit to sales.
And third party or cash sales.
I'm still confused. What is a trade accounts receivable?
And that's your regular accounts receivable. That's like when you offer credit. When you're offering credit, and if you have your own business and you offer credit on your own credit card, that's not a third party. A third party is Visa, MasterCard. Okay. Okay. All right, everyone is good on this one? All right, so that is the net method. What would it be under the gross method? So the answer is false. This is the net method, not the gross method. If it was the gross method, what would you do? You'd record cash at $12,000. So let me show you. So if this was the gross method, did I miss it? So if it was the gross method, you would debit cash, credit sales, and then when the fee is assessed, so that would be the gross method. Okay? So if that was the gross method, you would record the sale at the full amount, or the cash at the full amount of the sale, and then record the expense later. All right, any questions on the first topic or the first learning objective? Okay. All right, now, second, we're going to go back to the two issues that we spoke about earlier. So let me bring those back up. Then the word about is the proper valuation of accounts receivable on the balance sheet, and whether or not we're properly reflecting the expense of selling on credit. Now, to do that, we have to think about accounting for uncollectible accounts. So how do we account for uncollectible accounts? The first part of this, second learning objective, we're going to use a method known as direct write-off. And before we even start, the direct write-off method can be used for small businesses, and this is the tax approach, so that's why we cover it, because not everybody is going to be worried about this from a reporting standpoint, but it is the tax approach. It is not considered to be acceptable in most cases for generally accepted accounting principles because it does not satisfy the objectives of the balance sheet valuation and the proper expense measurement. So that, again, we have to think about when the cost of credit is incurred. And I'm going to tell you why this method is not considered GAAP at the outset. It's wrong for a couple of reasons. One, it does not record the bad debt until someone actually cannot pay, which could be a year or 2 years later, or it could be, definitely the problem is it's not in the year of the sale. So the issue is whether or not you should recognize the bad debt expense in the year of the sale. More likely than not, the direct write-off method will not, or the direct method will not recognize the bad debt expense in the year of the sale. Now, why am I so concerned with that? Well, when do you really incur the cost of bad debt? When do you really incur that cost? And if we think about some of the things that we've learned so far, again, trying to pull together concept. If I said that credit sales increase sales revenue. Right, so that's a statement that I made, which is true. If you only offer cash sales, you're going to have lower revenue. The cost of selling on credit, which is the bad debt expense, should be recognized in the year of the sale. And remember that concept? Matching. So we try to recognize a bad debt expense in the year of the sale to try to match it with increased sales revenue. Now, the direct write-off method does not do this. Direct write-off method fails to do that, and that's why it's not acceptable for GAAP. And you might ask, why do I use it for tax? Well, for tax, you're not worried about matching. Remember I said you got totally different objectives. You really need a totally separate course for tax, but I can give you a very simple reason. How do you know in the year of the sale what accounts will not be collectible? You have to estimate them. I mean, you don't know for sure, right? So I have no idea. If everyone in this room comes in to my retail store and buys something today, how do I know for sure who's going to pay and who's not going to pay? You don't know at the point of sale. It has to be estimated. So that's one of the bigger problems here, that this has to be an estimate. I'm going to talk about those estimation techniques. So that's why for tax purposes this cannot be used, or you've got to use direct write-off. So direct write-off fails. So let me repeat. The direct write-off fails to match cost with revenue. The direct write-off recognizes the bad debt only when the account is determined to be uncollectible, which could be next year, it could be 2 years from now, but it may not be in the year of the sale. That's the dilemma. The direct write-off method may not recognize the expense in the year of the sale. All right, so now let's take a look at those two options. So the two options that we're going to have. We're going to do direct write-off in this module, or this learning objective. The two methods we're going to worry about in this course will be direct write-off, or simply direct method, and the allowance method. Now, as I said, for GAAP, the direct write-off method cannot be used if you don't have to follow GAAP. And if you have a very small business, you might be able to use direct write-off, but the direct write-off method is, of course, permitted for tax purposes. When you have a direct write-off, you simply wait until you have information that the account is uncollectible, and you debit the bad debt expense, and you directly credit the account. So I'm going to say that again. When you have a write-off of a bad debt under the direct method, I know who you are. I know it's Smith or Brown or whoever it is, so I can credit that account directly. So I debit the bad debt expense, and I credit the specific account from the subsidiary ledger. I know exactly who that is, and I take that write-off at that time. Now remember, it's not going to be always going to be in the year of the sale. It fails to match cost with revenue because, again, it is possible that the bad debt could be recorded somewhere after the year of the sale. It could be recorded later than the year of the sale. So that's the problem with the direct write-off. It fails, as they tell you here, it fails to match cost with revenue. So under the direct write-off method, by way of summary, again, we realize that not all customers will pay, and the direct write-off method is only going to write off the bad debt in the year in which the account is uncollectible. Now, to show you an example, let's assume that we have this customer, Dan King, who tells us that, or they determine the individual cannot pay $200 on his account. Basically, what's going to happen is that once we find out that the account is uncollectible, we debit the bad debt expense and credit the receivable directly. So that's going to come off not only the control account, but that comes off the individual customer's account as well. So directly we write this off. And we do this only when they determine that the bad debt or the account is not going to be paid. Now, sometimes, and that's it for direct write-off. I mean, it's very simple. You just wait. Sometimes you do recover. And when you recover a bad debt, it means that the customer comes back to you and says, you know what, I can pay this, and I could pay some of it. And when you do that, you have two entries to make. The first entry reverses the write-off, and the second entry records the cash receipt. So the question now is, how do you handle a customer whose account you've written off but now comes back to pay you? Two things. One, you reinstate the account by reversing the write-off. And number one, I need to add to that, because number one, not only is it a mechanical reversal of the entry, it is restoring the customer's credit rating, because you're now putting the account back to where it was, and you're restoring that customer's credit rating in your books. So now you know that the customer did pay you and was not a bad debt. And then, of course, you record the receipt of the payment. So to recover, and again, this is pretty simple. Allowance method is much more complicated. Pretty simple. Let's say he decides to pay you back that account in September. You reverse the write-off by debiting the accounts receivable. You put the accounts receivable back on the books, and you credit the bad debt expense. So by crediting the expense, it reduces the expense. Remember we said that these accounts have normal balances. Expenses have a normal balance of a debit, but you could obviously reduce it by a credit. That reinstates the account, it restores the credit rating, and it reverses the write-off. Yeah, Lillian? Yeah, if it's half, it would be 100. So you'd restore half of the account. The other half, it just stays written off. It's still a bad debt, yeah. So half of it is collected, half of it's still a bad debt. Yeah, yeah. So it's not a full write-off, it's a partial write-off. And then you do collect. Yeah.
What happens if the customer just never contacts you? Is it a period of time?
Yeah, typically we're going to see this, it's an age trial balance of accounts receivable. Typically, there's a probably 120 days. Like most of my clients, at 120, it would go to an attorney. Some clients would pull the trigger faster, 90 days. They would send it to an attorney. It really depends. So they don't go more than 120 days usually, without writing them off. And then they write them off completely, send them to the collection agent, and the collection agent worries about it. If they come back with some money, there's a fee, but you get paid for something.
This way is not accepted.
Was it this method? This method is not accepted because this account could be written off 2 or 3 years after the year end. So it's not matching cost with revenue. Now, for tax purposes, of course, you have to remember that the IRS isn't going to say to you, why don't you estimate how much you think you're going to lose on bad debts and take a tax deduction? Of course not. They're not going to, not going to allow you to do that. So for tax purposes, you have to use the actual method. All right. So any questions on the direct write? There are some questions back there, but they're pretty much definitional. I'll ask you some other questions on the allowance method, which I think is more important. But I just want, there's some questions in the back of this module, and one of them is really addressing if it matches cost with revenue, or why isn't it acceptable for GAAP. Just realize that this is not acceptable for GAAP because it is not matching the cost of doing business on credit with the revenues generated. It is mismatching. So this bad debt could happen a year later or in the next month. So if you're preparing financial statements for August, you had August sales that were higher because of credit, but this bad debt is only recorded in September. So the expense is not in the proper period that the revenues were earned. Okay. Now, the method we have to use, let me go to Objective 3. We're going to Learning Objective 3. This is the allowance method. And this is much more complicated. We're going to spend a lot of time on this. This is the GAAP approach. And the most important thing about the allowance method is not only understanding it in principle, but it's also understanding it in terms of the fact that you have to estimate the bad debt. And how do you estimate it? Is it a percentage of credit sales? Is it a percentage of accounts receivable? Or is it an aging? And Matt will talk about the question before about how long do you wait before you write an account off? Well, essentially, you have an aging, so every customer, I can then get there. And someone asked me before about the dates. So I have a customer name, a customer account, and I have all of your purchases from me, all of my sales to you, in chronological order. I could have the computer sort them and take the balance and spread it out and tell me how much of it is current, how much of it is 30 days old, how much of it is 120, and so on. If you've ever seen, I don't know if you've ever seen, some doctors and some dentists do that. If you get a bill from a dentist or a doctor on the bottom, it has 30, 60, 90 days. Some of them do that. And they will age, they'll tell you your balance and how old your balance is. So we can do that. We have the ability to do that with the subsidiary ledgers. But the estimation techniques are going to be critical. So again, for the allowance method, this is the GAAP approach. This is the method we have to use under generally accepted accounting principles. And again, the issue is offering credit incurs a cost. By the way, another argument, the third bullet here, is kind of an interesting argument because they say not only are you matching revenues with the bad debt expense, you're also doing something that's pretty, I guess, logical in one way. When did you make the mistake on the day you sold the product to someone who was not going to pay you? I mean, you don't know that, but that's what they're saying here. That's a common statement. I'd rather go with the matching as the proper justification for the use of the allowance method. Now, the allowance method, if we're going to use it, we have to, and match cost with revenue, we have to come up with an estimate of a bad debt expense in the year of the sale. And that estimated bad debt expense is going to be based on experience. So we may know from past experience that 3% of our sales are not collected, 2% of our accounts receivable balances are not collected. So you know from your experience how many people don't pay. You may kick that up a little bit if the economy changes. Your experience could change. The same thing with warranties. When companies offer warranties, they have to estimate essentially what they think they're going to pay to cover those warranties. So they'll do that from past experience. Yep. I'm sorry, does it ever go higher? Yeah. The question, Anthony's question is, do you ever get a bad debt expense estimate that's higher than you really need because of conservatism? Yeah. It happens a lot because you could underestimate and you could overstate income by doing that. So when in doubt, you tend to go to the higher side of the bad debt. Okay. All right, and then of course to summarize, that's the allowance method, again based on matching, and we record the bad debt now, which means in the year of the sale, and we use our knowledge of accounts receivable. Basically, the older they are, the most likely they're not going to be collected. Now, the way we record this is going to be a lot different than the direct write-off method. It is recorded by using a contra asset account. And this is used to write the receivable down to what we consider to be its net realizable value. So we now have another adjusting entry in the package of adjusting entries that we've been looking at. So we make an adjusting entry that's going to debit the bad debt expense for whatever amount that's going to be. And it's going to credit an account called the allowance for bad debts, or let me make sure what are they using? Allowance for bad debts. Use an allowance for bad debts. Now, the allowance for bad debts is a contra asset account, just like accumulated depreciation. And on the balance sheet, and remember this is done in the year of the sale. On the balance sheet, you're going to have accounts receivable and the allowance. Accounts receivable has a debit balance. The allowance has a credit balance typically, and together that's known as the net realizable value. Of accounts receivable. Now, a couple of things to notice. When you debit the bad debt expense, you're matching that with sales of the period. When you have the allowance account and you reduce the receivables down to its net realizable value, that is the expected cash that you would hope to collect in the future. It's the expected cash flow from those receivables. So there's the balance sheet value at net realizable value, and the debit to the expense is the matching component. Now, just one other point, and that's a question I have for you. Why do we use an allowance account? Why don't we credit the receivables directly? The same question, if you remember, same question came up with what? Plant assets. Why did you use a contra? Why did you credit the accumulated depreciation and not reduce the asset directly? Well, that's not the expense side. I'm talking about the balance sheet side. The balance sheet side, yeah. Yeah, just like accumulated depreciation. It's an estimate. So that's one thing, but there's actually a more critical issue than that, yeah. No, not that it's a permanent account.
To keep a record of how much you're actually allowing per year, how much you're...
right? I mean, you want it, that's pretty much the same. I mean, it's an estimate. You want to keep track of that estimate as well. You don't know what customers are going to go bust. You don't know what customers are not going to pay you. So you can't write down the control account without writing down the subsidiary ledger. So if you credit accounts receivable directly, you would have to go in and start picking all the accounts that are going to be written off. You can't do that. It's an estimate in general. Now, there are some accounts we might write off directly, but this is a reserve or an allowance against all your receivables, not just specific receivables. So you don't really know at this point which accounts are not going to pay. You have no idea at this point. You simply are estimating. So a couple of reasons, good answers. Very much like the allowance for or the accumulated depreciation, you don't necessarily have exact numbers. You have estimates. The only factual information you have is the cost of a plant asset. Similarly here, the only actual numbers you have are the balances of the receivables, and you're estimating the allowance. And then, of course, the bigger issue is you don't know what accounts you're going to be writing off. This is just an estimate. It could be 3% of sales, as we'll see. It's just estimated. All right, so now let's go to an example. And we're just going to go through the entries first. And it tells us that at December 31st, Smart Touch Learning estimates that $80 of its 4,400 accounts receivable will be uncollectible. They don't know which ones right now. And again, that estimate will show you how to get that later on. So the entry here is a debit to the bad debt expense and a credit to the allowance for bad debts. That contra asset account, again, is going to be shown on the balance sheet as part of the receivables. Just like, if you remember, looking at the balance sheets in the prior chapters, when we looked at the adjusted trial balance and took those adjusted trial balance and put those on the balance sheet, you always saw that you had plant assets minus accumulated. Now you're going to have accounts receivable minus the allowance for bad debts. So that will look something like this on the balance sheet. So the net realizable value is going to be placed on the balance sheet, and it's not separable. You can't separate the allowance from the receivables.
What if these estimations are completely wrong?
They're correct. Good question. What if the estimates are completely wrong? They become part of your next year's adjustment. So they get adjusted year to year. So what will happen, for example, let me so in this example, I guess the receivables were 4,400 and the allowance was 80. And what could happen is that this could be totally, too much or too little. And in some cases, you could have a excess write-offs of accounts, which we'll show you in a minute. So again, this account could be, his question is, what if it's incorrect? If this is too much, next year's allowance will be less. We'll just reduce the amount. Instead of 80 or whatever the percentage is going to be, we'll make it a smaller number. If it's too little, we'll add to it.
Will it affect tax?
Not this one, because this is your book. Remember, 2 sets of books. So for tax purposes, I'm using direct write-off. I've got to wait until it actually becomes uncollectible. Once again, the IRS is not going to say to you, or the state of New Jersey is going to say, why don't you give me an estimate and take a tax deduction, right? I mean, you could imagine that can't be practical, right? Okay. All right. So again, on your balance sheet, you have the allowance for bad debts. Okay, so that's the way it looks. Okay. All right. Now, we already saw the write-off. So how do we write off an account on the direct write-off? On the direct write-off, we debited bad debt expense and credited the receivable. So far, we haven't written any accounts off. So let me just get back to where we were. I'll put this up on the screen in a second. So at this point, you got accounts receivable at $4,400. You have an allowance of $80, and your net realizable value is $4,320. Now the question is, how do you write the account off? How do you write off a bad debt? Well, when we write off the bad debt under direct write-off, we debit an expense. When we write an account off here, we write it off against the allowance. The allowance, I mean, we're not technically the term cushion or reserve or, some kind of like money in the bank is not really technical, but that's exactly what you have. You've already put $80 away for bad debt. So when an account is actually deemed to be uncollectible, you write it off against the allowance. There's no further expense. You've already expensed it in the year of the sale. You don't have to expense it again. So when we take a look at a potential write-off, let me do that now. When an account is deemed to be a bad debt, we don't write it off against an expense, we write it off against the allowance. The allowance account is there as a cushion, a fallback. You set that up to absorb the losses. So let's assume that we now have someone with a $25 uncollectible account. This is not an estimate, this is an actual that has to come out of his subsidiary ledger as well as the general ledger. So the entry is going to be to debit the allowance for bad debts and credit the accounts receivable directly. So what would happen when we write this off, I'm going to put this on the screen in a second. When you write this off, you're writing it off against the, let's get this up here. You're writing it off against the allowance. So the journal entry debits the allowance and credits the receivable. Now you're also going to credit the receivable now in the subsidiary ledger. So at this point, you could go into the subsidiary ledger and write off the account because you know who the customer is. You've got the customer's name. And for sure, you know who's the bad debt. Now notice that the write-off does not change your expenses. You've already taken the expense in the year of the sale or the month of the sale. No additional expense is charged. The other important thing is there's no cash flow effect, no cash, and if you look at the balance now of this account, the net realizable value of accounts receivable did not change. So when you have a write-off under the allowance method, the write-off goes directly against the allowance account, no additional expense, and does not change the net realizable value of the receivable. Why doesn't it change the net realizable value? You've already provided for it, right? I mean, you've already made a provision on what you expect to collect. Now, had a good question before, what happens if your estimates are wrong? Well, then we may have to tweak this next time around, but the bottom line here is that you've already accounted for bad debts, and as long as the bad debt stays within that range, your net realizable value will be where you expected it to be. So that was your projection, your expected net realizable value at 4320, and it's going to stay at that as you start writing off these accounts. Okay. All right, so any questions? We're not going to do anything yet on the estimation techniques, but any questions at all with respect to the allowance account and a write-off of an account. Okay, so the expense is recorded in the year of the sale. The write-off is recorded when it actually occurs. So let me get, yes? 25 is given to us in the problem. Okay, so that they tell you, I'd have to tell you what the bad debts were. I'm sorry?
You said a long section, but direct write-off versus allowance, is it one of them you cannot debit directly? You cannot credit directly, the other one you can.
Yeah, when you first set up the allowance account, let me answer this question. When you first set up the allowance account, first setting up the allowance, you don't know what accounts you're going to write off. So you don't credit accounts receivable directly. Now that you have a bad debt, you know the customer who's not going to pay, and therefore you're able to credit the receivable directly. Now at the beginning you don't know. At the beginning you have $80 that you don't know what customers are not going to pay. Oh yeah, but if you use direct write-off, then you would wait until now and write it off directly. The allowance method does not do that. Yep, right. Okay. All right, any other questions? All right, now, we saw a recovery. So what if our friend Callahan decides to pay? Once again, it's the same story. If you have a recovery of the receivables, you have to reverse the write-off, restore the credit history, whether it's partial or full, and then record the receipt of cash. The only difference is that there's going to be an allowance account instead of a bad debt. So in this case, let's assume again that you get a recovery, and now $25 is going to be paid. You debit the receivable, so you put the receivable back in the general ledger and the subsidiary ledger for that specific customer, and now you restore the allowance account. So you put the $25 back in the allowance, so you restore that, and then you also record the collection. So notice there's no expense involved. Again, the expense is only occurring in the year of the sale. So just make sure that we're going to spend most of our time with the allowance method, but you need to know both. So you had questions before. Make sure you know what method we're using. All right, so now the only question that remains is, how did you estimate that bad debt? Where did you get the $80 from? What techniques do you use to estimate? And we have a couple of methods. We have three methods, actually. We have one method which we call an income statement approach, which is called the percentage of credit sales. And we have two methods that we call balance sheet approaches, which are the percentage of receivables and the aging of accounts receivable. And what we mean by balance sheet and income statement approaches is the following. The percentage of credit sales approach, and remember we said there were two, let me go back to this first statement, and that is there are two objectives here. One is to come up with the proper valuation of accounts receivable. The other objective is on the income statement, is to come up with an estimated measure. And I'm not going to move this down, but we know that we're trying to match. Matching is the primary driver in here as the principal. Now, the question is, what method do you use to estimate? The estimated measure could focus on the expense and therefore may not give you the best valuation on the balance sheet. A balance sheet measure might give you a better net receivable balance, but may not give you the proper matching. So when you look at these methods, obviously if one focuses on the expense, it's got to force the allowance, correct? I mean, the number I put in here as a debit to bad debt expense has to affect the allowance. Or if I put a number in that I need for the allowance account, it's going to affect the expense. So when we take a look at these different methods, the theory or the logic behind them is that we have income statement approaches and we have balance sheet approaches. The income statement approach is the percentage of sales. The percentage of sales comes up with a target expense. I know what my expense has to be, and I don't really care too much about the allowance account and the net realizable value. So I take a flat percentage of sales, I debit bad debt expense and credit the allowance for that flat percentage, but whatever happens in the allowance account and the net realizable value is kind of forced. So my focus is on the income statement with the balance sheet kind of falling out. Now you might say, well, that sounds odd, but that is not. With respect to things that you're going to see in management and finance, there are lots of techniques that focus on one statement and not the other. So that you have some methods of accounting and some methods of analysis that are looking mostly on the income statement that don't really pay much attention or sort of give up a little bit on the balance sheet, and other methods of balance sheet focus. So the percentage of credit sales is an income statement focused account. It is going to emphasize the bad debt expense and de-emphasize the allowance on the balance sheet and the net realizable value. The percentage of sales, as you can see, is pretty simple, and we're just going to go over the theory today. The percentage of sales is pretty simple. I would have to give you what the net credit sales were, and I'd have to give you the estimated bad debt percentage. That becomes your target expense. That's the expense I have to record, and then whatever happens in terms of the allowance is, again, forced or becomes a byproduct of that computation. On the balance sheet approaches, it's just the opposite. On the balance sheet approach, our objective is to properly value the allowance for bad debts and to properly determine the net realizable value of accounts receivable. So what happens is that by coming up with the appropriate or the target measure of the allowance, you wind up forcing the expense. So to show you this, and again, we will see some examples, the first method is a percentage of accounts receivable. So if you look at the target balance, that target balance is the balance I have to have in the allowance for bad debts. So I take a percentage of receivables, and that becomes the target balance. If I have a credit balance in that account, I reduce the bad debt expense. If I have a debit balance, I increase it. So let me show you what that means with a very, very simple example. So let's say I have an accounts receivable with a balance of 500, and I have an allowance for bad debts with an existing balance of 40. And let's say my estimated target let's make it 10%. Let's say my estimated target is 10% of accounts receivable. So the target allowance is going to be 10% times 500, or of course that's 50. What is my bad debt expense? The bad debt expense is going to be $10. Why? Because I already have 40 in there. So this means that the bad debt expense is going to be the target allowance minus the existing credit balance. So my target allowance is 50, the existing balance is 40, and my bad debt expense is 10. So I'm going to debit bad debt expense and credit the allowance for $10. Now, what would happen if the allowance account had a balance of $20? What would be my expense? 30. So you see what I mean by forcing the expense, right? The expense is a byproduct. I need $50 in here no matter what. So essentially, I'm not big on sort of plugging T accounts, but it's not a bad idea sometimes. That's my target balance, and that's what I need. So I need to add $10 in there to get that to where I want it. But again, the last question I just asked you is extremely important, because that last question said, what would you do if the allowance already had only $20 in there? Then your expense is up to 30. If the allowance had nothing in there, your expense is 50. Could be, yeah. Yeah, so it depends on the information that you have. Now, this one other method I'll show you is very similar. And I'm going to stop right here, though, but just got to let me get to that. All right. And you can also do an aging of accounts receivable. The only difference with the aging, and I'm going to start with examples of this on Friday, but the only difference in the aging is that you provide an allowance against each aging group. So let me just show you what this means. Rather than taking a flat percentage, against the entire, rather than taking a flat percentage against the total accounts receivable, you provide percentages based on the age of the receivables. The newer the receivable, the less likely it is that it's going to be uncollectible. So you take 1%, but the old receivables, like the over 90 days, I'm going to take 90% of that and say that's what I need in the allowance account. So the only difference between percentage of accounts receivable and the aging is that the percentage of receivables applies a flat percentage against all receivables. This provides a percentage based on categories. Okay, we'll pick it up on Friday.